There are moments in the market when panic overshadows fundamentals. And last week we saw one of those moments. UnitedHealth Group, or UNH, experienced its worst single day in more than 25 years. The stock tumbled over 22% in a single session, wiping out more than $120 billion in market value. Now that kind of move isn't just rare, it's historic. But is it justified? In this video, we'll break down exactly what caused the sell-off, where the market might be overreacting, and why, for long-term investors, this could be one of the most attractive entry points in years. Let's start with what triggered the panic. UnitedHealth's Q1 2025 results came in softer than expected. Revenue was $109 billion, up year over year, but slightly below the forecast. And earnings per share came in at $7.20, missing analysts' expectations by a few cents. But what really rattled investors was the revised guidance. The company lowered its full-year adjusted earnings per share outlook from a prior range of $29.50 to $30 down to $26 to $26.50. That's a roughly 12% drop, a rare move from a company known for its stability. Management pointed to two key drivers. First, higher than anticipated care costs, particularly among Medicare Advantage members using outpatient services. And second, a shift in member mix at Optimum Health, a change that affected how much of the company can recoup in reimbursements. On the surface, these issues sound alarming, but let's dig deeper. One of the biggest misconceptions in healthcare investing is that demand is always predictable, but healthcare is cyclical, especially in Medicare Advantage. Utilization rates don't rise in a straight line. They ebb and flow based on factors like flu seasons, effective procedures, and even how accessible provider networks are. The spike in outpatient usage that caught UnitedHealth off guard this quarter, that's not a structural failure, it's a short-term surge, and the company is already adjusting pricing and risk models for future periods. In fact, they've stressed that the underlying fundamentals of both UnitedHealthcare and Optum remain strong, with solid membership growth and rising revenue per customer. This isn't a broken business, it's a temporary miscalculation. So why the extreme market reaction? Because in today's market, especially in mega caps, surprises get punished hard. When a company like UnitedHealth deviates from its ultra-consistent track record, investors tend to overcorrect. But here's the thing. Even with the guidance revision, UnitedHealth is still on track to earn around $26 per share this year. At the current price, that gives the stock a forward price-to-earnings ratio of just 17, well below its 5-year average of 21. And for a company with over $100 billion in quarterly revenue, high returns on equity, and market-leading positions in both insurance and care delivery, that's a compelling valuation. What many investors miss is just how integrated UnitedHealth's model has become. UnitedHealthcare provides insurance coverage, Medicare, employer plans, Medicaid, and more. Meanwhile, Optum delivers care directly through clinics, pharmacy services, and data-driven care coordination. This vertical integration gives the company more control over both costs and outcomes. Even during this challenging quarter, the company added 780,000 members to its self-funded plans, a major vote of confidence from corporate America. And in Optum Health, care delivery volumes rose by more than 20% year over year. That's not what you'd expect from a business in decline. Now let's also talk about capital discipline. In Q1 alone, UnitedHealth returned $5 billion to shareholders through a combination of dividends and share buybacks. The company generates over $25 billion in annual free cash flow and maintains one of the most consistent capital return programs in the S&P 500. Even after this recent sell-off, UnitedHealth's dividend yield is now approaching 1.7%, and management has a track record of annual increases for over a decade. For long-term holders, that's the kind of stability that compounds. UnitedHealth isn't just another insurer. It's the largest private health insurer in America, with over 52 million people enrolled across its plans. In Medicare Advantage, the fastest growing segment of the industry, it holds a commanding 28% share. Meanwhile, Optum, the company's care delivery arm, serves more than 150 million individuals annually across pharmacy benefit management, direct care, and health data services. That scale gives UnitedHealth unmatched bargaining power, data insights, and integration capabilities. In simple terms, They know how to manage risk better than just about anyone. And in healthcare, managing risk is everything. Now let's talk about demographics. By 2030, more than 73 million Americans will be over the age of 65. That's nearly 1 in 5 people, and most will be eligible for Medicare. This creates a powerful long-term tailwind for Medicare Advantage plans, one of United's core profit drivers. Now, yes, the company faced a setback this quarter due to higher than expected outpatient care, but demand isn't going anywhere. If anything, it's accelerating. And UnitedHealth, with its massive provider network and data infrastructure, is uniquely positioned to serve that demand more cost-effectively than smaller competitors. While most headlines focus on insurance, Optum is the real engine of innovation and margin expansion. In Q1, Optimum Health revenue per consumer served was up nearly 15% year over year. Volume growth was strong, and the business continues to scale vertically, integrating physicians, diagnostics, and digital care delivery. This means more control over patient outcomes, lower costs for the system, and more recurring revenue for shareholders. It's also a natural hedge. When insurance margins are tight, care delivery can help smooth the earnings profile. And Optum isn't slowing down. The company is reinvesting heavily in AI, patient navigation, and care-at-home models, all of which could drive future efficiencies and market share. Now let's put this recent sell-off into perspective. At current levels around $4.50 per share, UnitedHealth is trading at just 17 times forward earnings. That's a significant discount to its 5-year average multiple of 21 to 22 times. Back in January, the stock was trading at a premium to the S&P 500. Today, it trades at a discount. That discount between market price and underlying business quality is very rare. And it doesn't usually last long. As guidance stabilizes and quarterly results begin to normalize, there's a strong case for a re-rating back towards historical averages. Now, Wall Street sees this pullback as temporary. According to TipRanks, 17 analysts currently rate the stock with a buy, with an average 12-month price target of $635 per share. That's nearly 40% upside from current levels. Even the more cautious analysts acknowledge the long-term story remains intact. They see the recent adjustment in medical costs as a blip, not a breakdown. Meanwhile, UnitedHealth continues to receive praise for its integration strategy, data infrastructure, and risk management capabilities. This isn't a company in decline, it's a world-class operator facing a near-term headwind. It's easy to forget that UnitedHealth has navigated challenging periods before. In 2010, it was regulator pressure from the Affordable Care Act. In 2015, it was a pricing instability and exchange-based plans. In 2020, it was COVID. And in every one of those scenarios, the company emerged stronger. CEO Andrew Whitty and his team have consistently shown the ability to course correct, adjust forecasts, and realign their operating model as needed. They're not strangers to volatility, and the long-term decision-making has rewarded shareholders year after year. Even as it invests for growth, UnitedHealth remains extremely shareholder-friendly. The dividend has grown at a compounded rate of over 15% year over year since 2010. And with a conservative payout ratio, there's still plenty of room for further increases. On the buyback front, the company repurchased over $3 billion worth of its shares last quarter and still has billions more authorized. That means fewer shares outstanding, higher earnings per share, and a natural floor under the stock in moments of weakness. Now, when you invest in a company like UnitedHealth, you're buying resilience. Yes, this quarter was tough. Yes, there's work to do. But you're still looking at a business with market-leading scale, multi-channel diversification, billions in recurring cash flow, and secular tailwinds for decades to come. And right now, the market is offering that package at a discount. Historically, when UnitedHealth trades at these valuations, it tends to outperform over the next 3 to 5 years. So if you're a long-term investor, not a trader chasing headlines, this is the moment to lean on. Now to wrap things up. The recent UnitedHealth sell-off was dramatic, but not deserved. Short-term issues, while real, have overshadowed a structurally sound, highly profitable business with powerful long-term growth drivers. We've seen this play out before. Market overreaction, followed by recovery, followed by long-term outperformance. So take a breath, zoom out, look at the bigger picture. Because what we're seeing now isn't just a dip, it might be the best chance we've had in years to buy one of America's most durable companies at a bargain. Thanks for watching. If you found this helpful, be sure to subscribe for more breakdowns like this. And let us know in the comments, are you buying the dip with UnitedHealth?